This Chapter 2 fleshes out additional details on some of the remaining provisions of Basel III. The first of the topics we address in this chapter is counterparty credit risk, which refers specifically to the risk one party bears against the other under an over-the-counter derivative. The Basel regulators are of the view that a large number of deficiencies were observed during the recent financial crisis in the management of this risk, particularly with regard to 1. The computation of the so-called expected exposure under derivative instruments during periods of market stress. 2. The failure of most firms to set adequate credit valuation adjustments, or CVA, for counterparty credit risk, a term which refers to the mark-to-market loss one party incurs when its counterparty is downgraded and the derivative instrument in question has a positive value in favor of the first party. 3. The high correlation that became evident during the crisis among large financial institutions that are dominant players in derivatives. 4. The inability of most participants to recognize and guard against wrong-way exposure, which refers to cases in which the size of a bank's exposure to its counterparty is positively correlated to the default probability of that counterparty. An excellent example of wrong-way risk, at its most extreme, involves the purchase of puts from companies on their own common stock. If the put goes deep in the money, the large drop in the stock price presumably indicates that a significant deterioration in the company's creditworthiness has occurred, making it less likely that the company can honor the put if and when exercised. In the extreme scenario in which the put reaches its maximum intrinsic value, which happens when the shares are trading at zero, the company is certain to be bankrupt, and the put loses almost all value in the hands of the holder. 5. The unexpected delays in closing out positions with significant counterparties upon default, especially when the underlying trades were particularly complex or had illiquid collateral. 6. The destabilizing effect of margin calls triggered when the counterparty's credit rating dropped below some specified level, aggravating the financial condition of the counterparty and the liquidity stress it was experiencing. 7. The failure to clear a vast percentage of trades through central clearing counterparties or CCPs. 8. The use of securitized collateral, whose price volatility proved far worse than that of comparably rated sovereign or corporate collateral. And finally, 9. The inadequacy of most stress testing and backtesting methodologies. Some of the measures introduced by Basel III for dealing with these problems include the following. First, a requirement that expected exposure metrics be calculated on data that includes a period of stress. This is expected to increase capital charges by several multiples. Second, the introduction of a capital add-on that better captures CVA risk. Some very complex formulas and rules are needed for this purpose, and the usual choice between standardized and model-based approaches has been made available. Third, an explicit capital charge for specific wrong-way risk. This was manifested in several ways, but perhaps most importantly by monoline insurance companies selling protection on structured finance CDOs. Fourth, a 25% increase in the asset value correlation used for exposures to large regulated financial institutions and to unregulated financial institutions. Fifth, a limitation on the benefits that a bank may achieve on account of margin calls triggered by the counterparty's credit rating downgrade. Sixth, an increase in the margin period of risk, which refers to the number of days after making a margin call that a bank may continue to be unsecured. Seventh, incentives to use CCPs for clearing OTC derivatives by setting at a very low level the capital charge for exposure to any CCPs that meet specified conditions. Eighth, an enhancement in the management requirements for counterparty credit risk by making more explicit qualitative requirements for stress testing and back testing, and by revising model validation standards. And ninth, the introduction of a haircut on the value of collateral in the form of securitized instruments, as per the table that has just appeared. Also, a complete prohibition on the use of such collateral for regulatory purposes in the form of re-securitizations, such as CDO squared instruments. In this table, you will note that haircuts for securitization collateral are twice those for collateral from non-sovereign issuers, which are themselves twice those for collateral from sovereign issuers. You will also note the unsurprising pattern that as the collateral's maturity lengthens and its credit rating declines, the haircut increases. We turn next to the so-called leverage ratio, an entirely novel weapon in the Basel armory, but one that has been a feature of US bank regulation for many years. The common perception is that the banking system was excessively leveraged at the outset of the crisis, and that the need to deleverage rapidly once the crisis began only exacerbated the collapse in asset prices and in consequence of capital ratios of most banks. The new rules therefore include a maximum leverage ratio currently set at 3% and calculated without adjustment for the risk weight of individual positions. This ratio is additional to the risk-based Tier 1 and Tier 1 plus Tier 2 tests. Skeptics point out that the US had such a leverage ratio coming into the recent financial crisis, and indeed all through its recent financial history, with no obvious benefit over non-US banks. The exact calculation of this ratio has not yet been finalized, but the following elements have been listed as ones that are likely to play an important role in the calculation. 1. The measure of capital for purposes of the leverage ratio will be based on the new definition of Tier 1 capital. 2. Any physical or financial collateral, guarantees, or purchased credit protection are not allowed to reduce on-balance sheet exposures. 3. Netting in most forms is not allowed, so that gross exposure measures will appear in the calculation of aggregate exposures. 4. CVA adjustments will be ignored. 5. Certain off-balance sheet items, including guarantees and written credit protection, will be included in the calculation of aggregate exposure using a 100% credit conversion factor, or CCF. And 6th, all securitizations, repos, reverse repos, and securities lending transactions will follow their accounting treatment. We discuss next the capital conservation and counter-cyclical buffers, but first explain what is meant in bank regulation by pro-cyclicality. To begin with, when an economy slows down, the credit losses in loan portfolios increase, damaging banks' profits and retained earnings, and by consequence their capital ratios. Even the credit ratings of many performing borrowers diminish, raising their risk weights under Basel II and reducing further lenders' capital ratios. Banks' ability to provide loans therefore diminishes at precisely the moment when borrowers need increased lending to tide them over their current liquidity problems in anticipation of the economic recovery. In turn, this only exacerbates the economic downturn. Apart from the buffers we will discuss shortly, Basel III attacks the pro-cyclicality problem by reinforcing an existing rule that requires banks to use long-term data horizons to estimate probabilities of default. A second such rule prescribes the use of downturn loss-given default estimates rather than long-term averages, on the basis that recoveries on defaulted debt are typically lower than average when default rates increase above the norm. The new rules also make or propose three principal changes to the current regime in order to diminish pro-cyclicality. First, loan loss reserves will be set to reflect expected credit losses over the life of loan portfolios, rather than the current incurred loss approach, a change that has already been proposed by the accounting authorities and is supported by the Basel Committee. Second, banks will be required to build a 2.5% capital buffer outside periods of stress to be drawn as losses are incurred. This buffer is to consist entirely of Common Equity Tier 1. And third, banks may be required to build up a counter-cyclical buffer to be discussed in a moment. With regard to the capital conservation buffer, when a bank approaches the minimum capital requirement, it should retain a greater share of its earnings according to the matrix appearing now, which relates the percentage of earnings to be retained to the amount by which the bank's capital exceeds the minimum requirements in percentage terms. For example, if the bank's Common Equity Tier 1 ratio has dropped to 6%, the bank is required to retain 60% of its earnings. The rules further specify that the restriction on distributions cover all of the following items: dividends and share buybacks, discretionary payments on other Tier 1 capital instruments, and discretionary bonus payments to staff. We complete this chapter 2 with a description of the so-called countercyclical buffer. This second buffer adjusts the range of the capital buffer when there are signs that credit in the banking system has grown to excessive levels. The first step involves the identification of a macroeconomic variable or group of variables to assess the extent to which in any jurisdiction there is a significant risk that credit has grown to excessive levels. One suggested example would be the difference between the aggregate credit to GDP ratio and its long-term trend. That being said, the analysis would take into account variations in the stages of development of the financial sectors across the different jurisdictions. More relevantly, a breach of certain predefined thresholds would be used by the national regulators to expand the size of the capital conservation buffer described earlier by an amount determined by the national regulator, but always to range between 0 and 2.5%, depending on the severity of the overheating in the credit markets. The table appearing now shows the minimum capital conservation ratios a bank must meet at various levels of Common Equity Tier 1 ratio, and assuming the bank is subject to the full 2.5% counter-cyclical buffer requirement. To understand this table, note that the total range on the left, which was previously 2.5% wide, is now 5% wide, representing the sum of the capital conservation buffer and the counter-cyclical buffer at 2.5%. Each interval in this range is still 20% of the total width, i.e. 1.25%, and the minimum capital conservation ratio corresponding to each interval is the same as before. The idea behind the countercyclical buffer is to start building it up when the credit markets show signs of overheating, and then releasing it when they appear to be deflating. In so doing, the regulator would hope to slow down lending when it is frothy, and then reinvigorate it when it is lethargic. This completes this chapter 2.